Hello traders. Today we're going to take a look at backtesting, a poor boys covered call using the Thinkorswim platform. If you are unfamiliar with a poor boys covered call, I would suggest you go to the Tackle Trading Playbook and take a look at the bull call diagonal spread video. Poor boys covered calls are also known as bull call diagonal spreads. So that'll give you a nice rundown. I don't have the bandwidth to cover the strategy from A to Z in this video. Rather, I wanted to show how you would go about engaging in a back test of the poor boys covered call. So back testing the PBCC, poor boys covered call. A couple of steps here. Number one, you have to, with any back test, create a set of rules you will follow. The more complicated the strategy, the more complicated the rules, the more challenging it is to backtest. The simpler the rules, the easier it is to backtest. Okay, so I'm going to create a very simple set of rules for a poor boys cover call here. And so what I'm going to do is I'm going to use Apple, and the structure of the trade is we're going to buy a 4-month in the money call with a delta of 75, and I'm going to sell a 1-month out of the money call with a delta closest to 30. That is my entry criteria. Well, actually it's not. It's the structure of the trade. Now I got to figure out what my entry is. So let's say I want to enter fetch, I don't know. I mean, pick a date. Like, this is the challenging thing with a back test. With poor boys cover call, you kind of just have to pick when would you have started this trade. So I'm going to assume that I started it on a month where the stock was somewhat bullish. So if I say, hey, I would have started on Jan 1st, 2019. Would you have? I mean, was Apple bullish at that time? So I can actually go to the chart and say, well, I don't know. Let's pick just a random starting point. I'm going to go back a year, and I'm going to look at when this started trending higher here, maybe Feb 1st, when it first started to turn back into an uptrend. I'm going to give myself some credit here that I would have picked this uptrend up somewhere in February, when Apple went from a downtrend to an uptrend. Let's say we picked it up somewhere in February, and I want to map out how a poor boys cover call would have fared over, Feb, March, April, that kind of time frame, okay? Which is going to give me a good feel for how a poor boys cover call does in a really bullish environment. Okay, now if you want to do a really robust back test, I would pick a bullish environment, a bearish environment, and a neutral environment so that you can really see how the strategy performs in both positive and negative, both helpful environments and adverse environments, to get a really good feel for what to expect. So let's go back and let's assume we got in on Feb 1st just to have a nice easy start date. Okay, February 1st. So we're going to enter Feb 1st, and we're going to need some management rules. So I got the entry now, so I need some management rules. And with any stock trade, you have 3 outcomes. Stock goes up, stock goes sideways, stock goes down. And so let's say let me actually make it even simpler. Either the call stays out of the money or the call moves in the money. If the call remains out of the money, I'm going to ride to expiration, because that's a very simple rule, and it's going to be easy to fast forward to expiration and back test it. If the call moves in the money, I am going to ride close to expiration, and I'm going to roll out the call when there is less than, now Apple's a pretty expensive stock, so I'm going to say when there's less than maybe 30 cents of extrinsic value. So when I've milked all but 30 cents of extrinsic value in that short call, I'm going to roll it. Okay. Another thing that I have to specify is I'm going to sell 2 months against my 4-month option. Then I'm going to reset the trade by purchasing another 4-month option. So in other words, I'm going to buy a 4-month option, and then I'll sell 1 month against it and a second month against it, and then I want to get out of the 4-month option because it's only a 2-month option now. So I'm going to buy 4 months, sell 2 months against it, be done. Buy another 4-month option, sell 2 months against it, and be done. You might say, well, if you're going to do that, why don't you buy 6 or 8 month options? Because this is my back test, dang it, and I can do what I want. In this case, actually, I'm just trying to be simple. We may actually discover that it's better to buy 6 or 8 months. I just want to start with 4 for now. Okay? I've got my entry. I've got my exit here. And now I haven't really put in a stop loss. I've talked about how to manage the short call. I do need to kind of figure out if the stock completely craters, when am I going to get out? The issue here is if you have an always on system, it's easy to backtest because you know you do it every month. If it's tactical and some months you enter, some you exit, and then get back in at some point, you have to have rules around that, right? I have to have rules that kind of speak to each eventuality. I'm trying to be simple here. I'm going to assume I did this every month no matter what Apple looked like. Okay? Just to keep it simple. All right, so I've got my rules. I think that's enough. We may have to add to this here in a minute, but I think I've got enough to start. So now I just have to go back to February of 2019 in the Think Back tool. So I'm going to go to Analyze, and I'm going to go to Think Back, and I'm going to put in Apple, the ticker symbol, and I'm going to go back to I said Feb 1st, 2019. Now this takes a little bit of time sometimes for the computer to load it up because it's a lot of data. So you just got to be patient. So 2/1/2019, enter. That's going to load now the data for that day. So we're in February. So March is essentially the front month, April, second month, May, third month, June, fourth month. So I'd be buying the June options. And I said I wanted to buy a June call with a delta around 75. The closest one is the 150 strike. Closest one is the 150 strike. So I'm going to buy that. I would buy the June 150 call. That would be my long call option, which is going to serve as a substitute for buying stock. And then I'm going to sell a March call option against it. So we'll sell March, and then we'll sell April, and then we'll have to reset the trade. Okay? So for March, I'm going to go and look at, we said we wanted a delta around 30. Oof. So see, this is tricky. You have to decide, would you have sold a 40 delta or a 25 delta? Let's say I was trying to structure this, slightly more bullish. So if I don't have a 30 delta, I'll go with the one lower than that if it's kind of sixes. Technically, 25 is closer to 30 than 40 anyways. So I'm going to sell this 25 strike. So I'm going to hold the control key down, click on the, actually, I don't think I would do it that way. I think I would just have it as a single because I'm going to sell multiple of these against the June 150 call. Okay. Note that the prices here. I'm going to lock those in. We're going to lock those in. Those were the prices as of my trade entry. Now you could go put this in a spreadsheet or go put it on a Word doc to keep track. That's probably going to be smart to really get the gist here. So Feb 1st, 2019, I bought the June, I can't even remember, 150, sold the March 175, June 150 call, sold the March 175 call. That was sold at $1.82. This one was sold at, or bought at $20.82. Okay, so now I have both original trades. I got the trade date on Feb 1st there. Now let's walk it forward in time. So I kind of like to go back to the chart here. I'm on Feb 1st. So I'm short this 175 call right here. I'm going to draw it on the chart just to make my life easy here. I shorted the 175 call. I'm long the 150. Okay. Fast forward, fast forward, fast forward. Boom, 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 boom. All right. So right around here, the call goes in the money. And we're getting close to March expiration as well. Okay. This is a good thing. This is a good thing. So when I come to expiration, yeah, I can see that call went way in the money. So at some point here, I would have bought back the call. My rule, if the call went in the money, was to ride close to expiration and roll out when there was less than 30 cents of time value. So I need to go monitor the option chain, take this closer to March expiration. So you can change the date here. Move this forward to March expiration. It was about the beginning of March when this thing went in the money. So here we are, March 4th. And the stock has gone up to 175.85. So my 175 call is now in the money. I can take a look here and see right there, it's in the money, it's shaded in blue. I can change one of the column headings to extrinsic value, and you can see there were still $2.05 of extrinsic or time value. So per my rule, I wouldn't get out. I would not get out. And you got to go pretty far in the money or be pretty close to expiration for the time premium to get to 30 cents. So let me just fast forward here. Now the stock's gone up to 181. My 175 call has 28 cents of time premium. So I'm going to pretend that that is when I would have said, all right, enough's enough. I've milked the time premium. The call's in the money. Per my rules, I'm going to close this. I'm going to close this out. So I'm going to assume that we bought this back, let's say $6.15. So I'm going to click on the ask price. I'm going to assume we bought it back at $6.15. That was the exit. Now, that first month, you'd say, okay, so what was the tally? Well, I sold the call for $1.82, and then I ended up buying it back for $6.15. Sometimes that's what happens with these types of trades if the stock goes up a lot. So I basically lost $4.33 in the short call that month. $4.33 in the short call. So again, I could put all this in here. The date was March now 12th, 2019. I bought back the March 175 call at $6.15. $6.15. So that is a loss of $4.33. Now, the June 150 call, let's see how much that is worth. Because you're going to have an unrealized gain in that other call. So let's go to June, and let's go to that 150 call. It is worth $32, let's round it 50 cents. $32.50. Okay, $32.50. So that has an unrealized gain of $32.50. I bought it at $20.82. I'm up $11.68. Okay, and so basically the total position profit at the end of that first month would be $11.68 minus $4.33. $7.35. $7.35. Now my original trade cost was, that's a nice round number, good. $20.82 minus $1.82 is $19. So if I made $7.35 that first month, $7.35 divided by the trade cost is a 30, rounded up, 39% return. Okay, so I know that the poor boys covered call for that March expiration I was playing with, because Apple went up so much, netted me a 39% ROI had I closed the long call at that time. And that makes sense. If I look at the chart, you know, we entered right around here when the stock was at 166. If I fast forward to that March 12th, you're right here. I mean, the stock's gone up 15 bucks. You've had a bunch of time pass. A normal cover call would have been making money. A poor boy's covered call is making money. The difference is the poor boy just has a better ROI because it was cheaper. So that's me modeling out 1 month's performance. Now I need to follow my plan here, and I would have sold another covered call on March 12th. So I would have bought back my March call. See, we rode this to where it had about 3 days left. So we got out a little bit before expiration. Then I would have sold an April call. Which call would I have sold? The one with a delta closest to 30. Well, here I got a 38 delta, or I got a 22 delta. So I probably, that's tough. I don't know. You could go either way on this. Again, if I'm leaning more bullish, I would have sold the 23 delta. So let's go ahead and go with that. Knowing that the chart was more bullish at the time we were considering this adjustment. That's what we would do, okay? So I'm going to sell the 190, the April 190 call for $1.40. And this is on March 12th. So again, going back to the chart. Boom, 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 boom. Where's March 12th? Right here. Perfect. Okay. So basically, I would have taken that 175 call for March, bought it back at a loss, and then rolled it up to the 190. So I would have rolled up to 190 and out to April. This is rolling up and out to reestablish this trade in April, and now I'm short the April 190 call. Okay, so then I fast forward. I say, all right, let's go to the next month. Forward, 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 forward. Now we hit 190 pretty quick. This thing was ripping higher. Would I have bought back the 190 call? No, because my rule says to wait until close to expiration when there's little to no time value. So let me fast forward closer to April. All right, so let's go to like April 5th or so. That call is getting pretty far in the money. Let's go to April 5th. So advance the timeline. 4, 5. Stock's at 197, and I'm looking at my April 190 call. I'm looking at my April 190 call. And this is worth about $8, but it's still got 92 cents of time premium or extrinsic value. I can go a little bit further. So let me go the next day. Oh, it's a weekend. Okay, coming back on Monday. Now there's 50 cents of time premium. Getting close. 70 cents of time premium, 45 cents of time premium, 38 cents, close enough. I'm thinking here I want to buy it back. Not much time premium left. So let's go ahead and buy it back. We would have paid about $9.30. Make it $9.30, keep the math easy. Okay, so that is on April 11th. So April 11th, 2019. I'm going to buy back. Notice the typo. I'm going to buy back the April 190 call at $9.30. I originally sold it for $1.43. Ooh, I took a bath on that. $1.43. By the way, I have to put this here. So the new short call is I sold the April 190 call at $1.43. Okay, so I bought it back at $9.30. I mean, you can see I let that call go way in the money because of my rule. My rule was just to ride and milk the time decay. So I lost $7.87 on the short call that month. I better have made a bunch of money on the long call. So the June 150 call, how much is that now worth? Well, I'll give you a hint. The stock's at 199 bucks, so that call should be worth quite a bit. So if I go look at my June 150 call, it's now worth about $49 and call it 40 cents. $49.40. So the call has gone to $49.40. So I have an unrealized gain. And actually, I'm going to sell this call now because I've sold 2 months against it. It's now only a 2-month call option, so I'm going to sell it. And I'm going to make $49.40 minus the original purchase price of $20.82. Make $28.58. Okay. So, final position profit. I made $28.58 on my long call. I lost $7.87 on the short call that month. But on the prior month, I lost $4.33. So if you take into account the losses on both short calls, the gain on the long call, you made $16.38 over those 2 months. And my investment, my initial investment was 19 bucks. So that's about an 86% return over those 2 months. You say, wow, that's fantastic. Well, yeah, but look what Apple did. I mean, what was my date we ended? April 11th. And look what it did through April 11th here. I mean, you entered when the stock was at 166. It runs up to 200. You better be making some good money on some kind of bullish trade. That's a big move. So the takeaway is poor boys covered calls work fantastic when you're in a pretty bullish environment. They generate a higher ROI than you would otherwise get on a traditional covered call. The other takeaway is it's a good thing we sold some lower delta calls. That allowed us to profit quite a bit before our short calls went in the money. Had I sold 40 delta calls, this wouldn't have been as good. Wouldn't have been as good. Okay? So essentially now I need to reset the trade because I'm no longer in the June call. I just closed it. We're now in April, so May is the front month, June, July, August. So August is now a 4-month call. So I need to buy in August 75 delta. Let's go 72 delta. And then sell a May 30 delta against it per the guidelines. So just put those two in here and then track that moving forward. Track that moving forward. Okay. So I basically have a catalog here, a record of every entry and exit. And did I put in the exit for the June? No, I forgot to put in the exit for the June. So let me go back and do that. So I sold the June 150 and got the 49.30 or so. All right, so now once I put all that in there, you should be able to see the equity curve for your trade. So in the underlying and P&L graph down at the bottom, if you go to where we started the trade in February, you'll see this yellow line tracks your P&L, how much money you would have been making over the duration of the trade. Okay, until you put in the exit price. So essentially, I put in each leg. The June call, I have one entry. Later, when I sold it, I got one exit. The March call that I sold and then bought back. The April call that I sold and then bought back. The new August call option. So it will track your overall P&L, throughout the trade. And so if I bring this back to April 11th, which was the last time we closed out, the yellow number over on the left, it's actually up top up there. Basically, $1,500 is what it's saying we were up at that point, when you take into account all the gains and losses for the trade. So you could also add it up manually in the Word doc like we did, or look at these numbers here. Okay, so just make sure you put in an entry slot for the one when you bought, and then an exit when you sell, and vice versa. If you sell first, you have one line and one line for buy. And then if you have all that at the end, let me take out this August one here. You basically should have the same number of buys and sells. Okay, take out the May one as well. So I should have the same number of buys and sells, and then it'll track the overall P&L for that position. Okay, so basically I would just keep doing this month to month to month, and eventually resetting the trade up, buying a new 4-month option after a couple of months of owning the prior one, and then just do what I did, rinse and repeat over any time frame you want. And what you'll discover is just what is the poor boy covered call designed to do? Does it make money over time? Does it lose money over time? I cherry-picked and looked at a very favorable environment for a poor boys covered call. It would also be interesting to see what it did in a poor environment. But then you can kind of better customize your rules when you have a decent background or context of how the trade would have fared. All right, so if you got any questions, let us know in the clubhouse as usual. This has been Tyler Craig with Backtesting the Poor Boys Covered Call. We'll see you next time.